Hello everyone, this is Mehak Agarwal from Vinod Kothari and Company, and in today's video, we will be discussing loans from shareholders and directors by private companies. So, private companies are generally family-held companies. That is, the shareholding in these companies are generally held by the family members themselves. So naturally, when a private company is in the need of short-term funds, it resorts to its members for such funding. So now what is the regulatory regime around acceptance of funds by a private company from its shareholders? This is covered under Section 73 of the Companies Act, read with Rule 3 of the Deposit Rules. So a private company may accept loans from its shareholders up to a maximum limit of 100% of the paid-up share capital, free reserves, and securities premium reserve. That is 100% of its net worth. However, there are also certain classes of companies that have been specified that are allowed to accept funds in excess of this limit. What are these classes of companies? Number one, if you are a startup within 10 years of your incorporation, you may exceed the limits of 100% of your net worth. Number two, if you're a private company which fulfills three conditions. Number one, if you're an associate, if you're a company which is not an associate or subsidiary of another company. Number two, your borrowings from banks, public financial institutions, and other body corporates does not exceed twice your paid up share capital or 50 crore, whichever is lower, and at the same time, you have not defaulted in repayment of these borrowings, then upon satisfaction of all these three conditions, you are allowed to accept loans from your shareholders in excess of the limit of 100% of your net worth. In each of these cases, the details of the amount accepted will also have to be filed in Form PPT3. Now, when a private company accepts loans from its shareholders, there are certain conditions that it has to comply with. These conditions have been laid down under Section 73, subsection 2, clause A to F. Now, what are these conditions? Condition number one is that when you are accepting deposits from your members, you will have to send a circular to the ROC in Form DPT1. The circular contains the details of the financial position of the company, the credit rating of the company, the number of depositors, and the amount of deposit outstanding as on date. This circular also has to be sent to the members within 30 days of sending it to the ROC. At the same time, the company has to transfer an amount which shall not be less than 20% of the amount of deposits maturing during the next financial year within 30th April of the current financial year. The next is the company has to provide a confirmation that it has not defaulted in the repayment of any of the deposits, and in case there has been any default, then the same has been made good and a period of 5 years has lapsed since making such good. Lastly, point number F talks about creation of securities on deposit. However, creation of security is not mandatory. This deposits may also be unsecured. In this case, the company will have to mention in every circular that the deposits are unsecured. Again, there are certain classes of companies that have been exempted from the requirement of Section 73, subsection 2, clause A to F. What are these companies? Number one, if you're a company who's accepting deposits not exceeding 100% of your net worth. Number two, if you're a startup company within 10 years of your incorporation. And number three, if you're a company fulfilling three conditions. That is, you are not a subsidiary or associate of another company. Your borrowings from banks, public financial institutions, and other body corporates does not exceed twice your paid up share capital or 50 crore, whichever is lower, and you have not defaulted in repayment of such borrowings, then upon satisfaction of all these three conditions, or if you're a startup within 10 years of your incorporation, or a company which does not exceed the limit of 100% of its net worth, then the requirements of Section 73, subsection 2, clause A to E does not apply to you. Now, if you refer to the discussion we had a while ago and this discussion, you will notice that in case of two classes of companies, that is, startups within 10 years of incorporation and companies complying with these three conditions, that is not an associate or subsidiary of another company, borrowings from banks, financial institutions not exceeding twice the paid up share capital of 50 crores, whichever is lower, and which has not defaulted in repayment of its borrowings, these two classes of companies are exempt from both the requirements, that is, the requirement of complying with maximum 100% of net worth, as well as the requirement of complying with Section 73 to A to E. Now, another important thing to note here is, while the exemption notification specifically talks about exemption from point A to E, however, it is to be understood that point number F, which talks about creation of security, is also not mandatory. In case the deposits are unsecured, the same is required to be mentioned in the circular, which in case of these companies, the requirement of circular itself is exempt. Coming to another point here, what happens if the limits of deposit exceeds the level of 100% of paid up share capital, free reserves and securities premium reserve? So if the deposit exceeds this limit, then section 73(2) A to F becomes applicable on the company again. And if we read section 73(2) along with its relevant rules, we will see that a lesser amount is permissible as to be accepted as deposits. That is a percentage of only 35%. So this is to say that if a private company wants to avail of the exemptions from compliance with the requirements of section 73(2), it should ensure that it stays well within the limits of 100% of its net worth. Having said that, the details of the amount accepted will have to be disclosed in Form DPT-3. Coming to our next discussion for the day, that is acceptance of deposits from directors. So the acceptance of loans from directors is considered as exempt deposit under the deposit rules. This is to say that a private company may accept loans from its directors as well as the relatives of such directors. In this case, there is no maximum limit that has been prescribed. But while accepting loans from the directors, the private company has to ensure that it obtains a declaration from these directors stating that such amount is being given by the directors from their own funds and not from borrowed funds. At the same time, the details of such borrowing will have to be disclosed in the board's report of the company as well as in Form DPT-3. Coming to another crucial discussion. Now, the definition of relative under Section 2, Clause 77 of the Companies Act also includes members of the HUF. Now, when it comes to HUF, there are multiple views. It appears that loans from an HUF can be taken only if the HUF itself is a shareholder of the private company. At the same time, since a director of the company is required to be an individual, an HUF definitely does not qualify the exemption of a director. Now, when it comes to other cases of acceptance of loans from the HUF, either in the capacity of a shareholder or in the capacity of a director, there are two possible views. The first view that is taken is that the HUF is no different from its constituents. In that case, loans can be accepted from the HUF. The other view is that the HUF is a distinct entity different from its constituents. Therefore, loans from the HUF cannot be taken as exempt deposits. However, yet there is no clarity on which view should be taken. We hope this discussion helps. In case you have any queries, please feel free to drop them in the comments below. Hope you have a nice day. Thank you.